Everyone's making backdoor Roth contributions way more complicated than they need to be. So in this video, I'll explain what a backdoor Roth contribution is, why someone would do it, and how to avoid a major pitfall. On the left-hand side, you see a direct Roth contribution. This is a normal contribution. Your money goes from your bank account directly into your Roth IRA. A backdoor Roth contribution, on the other hand, is where you take money from your bank account, do a non-deductible contribution into a traditional IRA, and then you convert the contribution into your Roth IRA. So ultimately, there's just one extra step between getting money from your bank account to your Roth IRA. So why would someone want to do a backdoor Roth contribution? It's because the IRS has income limits on direct Roth contributions. It's about 150 grand if you're single, or around 230 grand if you're married. So if your income is above these limits, you can still get money into your Roth IRA, you just have to go through the back door. The major pitfall to watch out for is if you have a traditional IRA, a SEP IRA, a simple IRA, some other IRA with tax-deferred money, because that complicates the transaction. If you have one of these IRAs and you decide to do a backdoor Roth contribution, some of the conversion amount will be taxable. Here's an example of someone with a traditional IRA balance of $100,000 and still decides to do a backdoor Roth contribution. They do a $6,500 non-deductible IRA contribution, and that brings their total IRA account balance to $106,500. Then the person converts their $6,500 contribution into their Roth account. The trouble is, at the end of the year, the IRS requires you to aggregate the balance of all of your retirement accounts and apply the pro rata rule. So of the $6,500 that was converted, 93.9% is taxable and 6.1% is non-taxable. So at the end of the day, the person doing the conversion is going to have to pay tax on $6,100 and only gets $397 in tax-free. This can make the Roth conversion a lot less attractive, but there is a solution to this. So let's make a new scenario and call it scenario 2. In this scenario, before doing the backdoor Roth contribution, the taxpayer takes the $100,000 sitting in their IRA and moves it to their 401k. Now the taxpayer's traditional IRA balance is zero. They do the non-deductible IRA contribution. It brings their total IRA account balance to $6,500. They do the conversion, and none of it is taxable. So to recap, step 1, if your income is below the direct Roth contribution threshold, then turn this video off, just go with a normal Roth contribution. If your income's above the threshold, then take stock of all of your tax-deferred IRA accounts and look at potentially moving them into your traditional 401k to bring your IRA account balance to zero before doing a backdoor Roth contribution. Next, you can open up a fresh IRA account, do a non-deductible contribution into the account, and then convert it to Roth completely tax-free. And lastly, make sure to keep records of this and let your tax accountant or whoever's preparing your taxes know exactly what you did so they report it correctly on your taxes.